All right, so we had quite an interesting week in the markets. I did make a video on Monday going over the craziness that happened on Monday. So if you didn't check that out, check that out. But basically, Monday we were down massively. We had the probably the fourth time I think it was where the VIX went above 40 in the 21st century. So basically something that happens every 5-6 years, at least based on that metric. So massive amounts of volatility. And I think something that we have gotten kind of lucky as far as investors go over the last 9 or 10 months is not a lot of volatility. And I think that's something that we're going to have to get used to going forward. Now, do I think it's going to be days where we're down 3%, the NASDAQ down like 4% or whatever it was? I think that's not necessarily normal, but this basically perfect trend up over the last 9 months or so, that probably is unlikely to happen over the next, 6 months, 8 months, 9 months, or a year, whatever it is. So keep that in mind. But my main takeaway from that video was I didn't think the sky was falling, basically. And I said that I think over the short term we'll see a bounce, which is exactly what happened. Basically on the week, the markets were basically flat. The S&P was down very slightly. The NASDAQ was down very slightly. Small caps were down a little bit, but mid caps were actually up a little bit. So the markets as a whole, nothing crazy. Like if you would have just heard, the markets were down ever so slightly, you would have shrugged it off like, oh, no big deal. So I still think that it's not that big of a deal. My prediction still stands that I do think we probably trend up over the next week or two, maybe month. But over the next 2 or 3 months, maybe it's even next week, but nobody knows. But I think by October, November, I think we probably test the recent lows on the S&P. I think we go down to 48, 4,900, maybe 5,000, maybe 51 on the S&P, which we did get down to just above 5,100 on Monday. So I think between 4,800 and 5,100, that's probably I think where we'll test. And then we whether it's November, December, maybe October, we trend up from there. The big question is, and the big way we'll know for sure what's going to happen is, and again, we can never know for sure what's going to happen. I shouldn't put it that way. But the most likely scenario is, where is the next high? Over the next week or 2 or 3 or 4, whatever it is, do we hit a new all-time high? Or do we peter out at 53, 54, 5,500 on the S&P and go back down? Because if that's the case, then what that means is we just made a lower low and a lower high. And that means that chances are the next time we pull back even more. So that's what to look out for in the markets. Where do we top? Where do we top? The next thing I wanted to bring up here is Bitcoin. Bitcoin was up very nicely on the week, and I also brought up in my last video on that if you look back in early July and on Monday, Bitcoin bottomed out at around 75,000 Canadian, which is about 54, 55 US, and it's bottomed out almost exactly right around there over the last 2 times it's pulled back. So that appears to be some pretty strong support for Bitcoin. Now, again, support doesn't guarantee anything, but that appears to be some pretty strong support. I think that once we get rate cuts, once we get the stock market shrugging off its struggles, for lack of a better way of putting it, I think that we could easily close the year at 100,000, especially if Trump gets elected. That'll be very bullish. We could easily end the year at 100,000, and we could go up another 100, 200% in 2025. Historically, usually it's the year after the halving where you get the majority of the gains. So, and that's what happened the last bull run. It was actually, I believe it was 2021 that made more gains than 2020, but I could be wrong on that. So keep an eye on that, because I think Bitcoin, we're going to see a very, very healthy bull run in Bitcoin. I think we go up 100%, 200% from here in this halving cycle, and you never know, it could even be more, but that's just my prediction. Again, obviously I could be wrong. So anyway, let's get into earnings from this past week, because we did have another busy earnings week, although it wasn't as busy as last week. Capital Southwest is the first one that's on my list here. They're a dividend play, that's why you're buying them. And obviously 9.7% yield. They missed earnings. They did beat revenue. They were actually up on that news. The next one is AMR. This is a name that I do have on a watch list. This is one that's also very popular. It's talked about a lot. This is a coal name, and I haven't bought this company for the reason that it's very hard to value and get a good representation. I do think that the idea that we're going to transition completely away from renewables is a pipe dream, unless people want to lower their standard of living drastically. So again, we're going to need companies like this. The real question is to what degree? And I think that's kind of hard. And again, the other problem with companies like this is that governments can play so much of a role in the value of their product. And that's why that kind of leans me towards avoiding them. But again, obviously I could be wrong on that. The next one is IIPR. Of all the companies I own, this is the one that has the highest dividend yield, and that's because I bought it back in May of 2023 when it was yielding about 10% back then, but they've raised their dividends since then, and I think my yield on cost is around 11% now. It currently has about a 6.5% yield. I do like this company. This is one of those names that I think is a good risk-reward play. It's obviously it's a marijuana REIT, if you didn't know that. And I think that when you look at the regulations and the sentiment on that over time, it's going to get more loose, which should help a company like this. Also, with rates probably going down, they're inevitably going down at some point. That will help this name. So I do like them. I think they're probably about fair value where they're at right now. So again, I don't think you're necessarily getting a deal where it's at right now, but I do like this company. And if you don't have a position, I probably would pick it up on pullbacks. But again, just my opinion here. Obviously, everything my opinion. Realty Income. This is a name that's very popular in kind of the social media finance space. I don't like it for the reason being, number one, over the last 5 years, the share price is actually down. And number two, I don't think it has a lot of long-term growth potential. If you look at a company like Alimentation Couche-Tard, I think they're a way better option than Realty Income. They obviously don't have as high of a dividend, but their share price has absolutely destroyed it, and they have way better dividend growth, which is where the real dividend investing is and where it should be. So I don't like it. They released pretty shaky earnings. They did beat revenue, although they missed earnings. The next one is Palantir. This is a company that I definitely would buy at some point. I think it's just way too expensive where it's at right now. I think it's probably 50% overvalued. I do really like the company, though. I think that it's in a good area. I think the long-term growth potential definitely is there. It's just way, way too expensive. The next one is Caterpillar. So I do have a decent-sized position in Caterpillar. I am dollar cost averaging where it's at right now. They did beat earnings and revenue, although they did lower guidance slightly, which caused them. Actually, I didn't actually pull up the stock here. It doesn't matter though. They're actually up on that news, but again, like I said, they did lower guidance a little bit. But I think with an economy that needs building, whether it's roads, whether it's actual building of buildings, this is a company that's going to benefit from that. And with our population growth, we're going to need roads, we're going to need buildings, and a company like that is going to benefit from that. The next one on the list here is LCII. This is a company I have on a watch list. I do like it. I think it's a solid company. I mean, it has a 13% free cash flow yield. It did release fairly solid earnings, beat earnings and revenue. They were up on the week. I do not have a position, but I would buy them if the price was right. Owens Corning. This is a name I've been buying recently. I really do like it. It's got a 10% free cash flow yield. I don't think it's overly expensive where it's at right now. Did beat earnings and revenue, although it was down on the week. But this is a name I definitely do like. The next one on the list is BLD. This is Top Build. Similar industry here. This one, again, I never have bought it. I would buy it if the price was right. I think it's a decent company, but it did miss earnings and revenue, which also gets me a little bit concerned there. But I think it's a solid company. If it was cheap, I might pull the trigger, but I do have it on a watch list at the very least. The next one is QLYS. This is a company that I think definitely is undervalued where it's at right now. I definitely am buying it where it's at right now, and I would be buying it up until 140 for sure, maybe even 150. This is a company that I think will beat the S&P. I really do like it. it's a tech name, but again, it's only a $4.6 billion market cap. I really do like it. It's easily beat the S&P in the past. I think it will beat the S&P in the future. And I mean, it has a 18 price to free cash flow. So if you can get a company that's going to beat the S&P for an 18 price to free cash flow, I mean, that's probably roughly what the S&P is, probably a little bit below maybe, but this is a company I think will beat the S&P. And I mean, for a tech name that's growing as well as it's growing, to me, it's a no-brainer. I mean, there's companies that are not growing as well as this company is growing that are trading for 30 price to free cash flow. So that's why I'm buying this company. I really do like it where it's at right now. This is one of the few tech companies that I think is clearly undervalued where it's at right now. SMCI, this company I think is overvalued. Again, they're free cash flow negative. Decent company. I just think they're too expensive where they're at right now. I mean, given they're not even free cash flow positive, it's kind of hard to say, yeah, I should be buying this company. They did miss earnings. They beat revenue. Disney was probably the largest company to release this week. They released solid earnings, although they were down on the week. I would never buy Disney for many reasons. Number one, I don't think they necessarily have as good of a moat as what people think. Not that they don't have one at all, but I don't think it's as good as what people think. And then there's other unrelated reasons that I wouldn't be buying them. CF Industries, this is one of the bigger fertilizer names out there. They did release very good earnings. They were up on the week. This is a name I've held in the past, but I do not hold it right now. EQIX, this is one of the biggest, if not the biggest, data center REITs out there. Again, a company I have a small position in. I would definitely buy it if you could get it for a good price. It hit about $700 a share back in April. If you could get it for that, I definitely would be buying it. If you could get it for below, let's say a 20 price to FFO, that's where I would look to pick it up. It's at about a 24 right now. The next one is Monster. Monster released pretty bad earnings. They were down on the week. They're basically at a 52-week low. I still think they're too expensive where they're at right now, though. I think they're going to be all right long term. But the problem with a company like this is that they have no moat. I mean, competition is it is so easy to start your own line of energy drinks, and they're not really well diversified. So that's why I've never bought them. If they got cheap enough, I probably would buy them because, I mean, they do have a pretty good brand, but how many people, like, I know a lot of people who drink energy drinks. I drink energy drinks myself. I don't know anyone that absolutely insists on drinking one brand, though. So that's kind of the problem with Monster. So I do think that they're so well established that they're kind of, I don't really know a better comparison. Maybe Walmart, that not a lot of people absolutely positively insist on going to Walmart. They're already so prevalent and so there that people just kind of go. I don't know if that's a good comparison, but I think you understand what I mean by that. Primerica, this is a company I'm currently buying, even though it's basically at a 52-week high. This is a company that has beat the S&P. I think it will continue to beat the S&P, and it has a PE that is a little bit below 15, and the S&P is currently at about 20 or 21. So a company that's 25-30% cheaper than the S&P that I think is going to beat the S&P, to me that's a no-brainer. So I really do like Primerica. They did release pretty good earnings. They were up on the week, and then, like I said, they're basically at a 52-week high. I really do like insurance companies too. There's probably 4 or 5 insurance companies right now that I'm buying. I think it's a very good industry. I think it's probably one of the most underrated industries because the returns are so predictable, and it's something you need. And not only that, I mean, like when it comes to a recession, you still need car insurance, you still need health insurance, you still need life insurance, like et cetera, et cetera. Like, yeah, the amount, like car insurance, for example. Yeah, if you get a recession, people aren't going to be buying as many Lamborghinis and Corvettes and stuff, but you still need it. You still need home insurance. And when the value of houses are going up, when the value of cars are going up, that just means more premiums for the insurance companies. So government regulation is something that would be a little bit concerning, but the industry as a whole, the government can try and play hardball, but I think it's if the government tries to play hardball too much, I think they lose. I don't think they have as much leverage as what people think. WTS, this is another company I really do like, Watts Water Technologies. I think they're a little bit undervalued where they're at right now. Not a lot, but definitely a little bit. They did release very good earnings, and another company that I am buying where they're at right now. Parker Hannifin, this is a company that I have on a watch list. I probably would buy if it was the right price. They did beat earnings and revenue. They were up on the week. Too expensive where they're at right now, but I would buy them if the price was right. And the last one here, CEIX. They did beat earnings and revenue. They were up on the week. I think they're a little overvalued where they're at right now. I do have a very small position in this company, but I don't know if I would buy again. I would look to pick it up probably like below like $80 a share. I think it's a little bit overvalued where it's at right now. That's basically my cost basis. That's part of the reason why. They do pay a pretty solid dividend. Let's check and see there. Actually, no, it looks like they cut their dividend very recently, at least according to this. They haven't paid one since 2023, so I'm wrong about that. Sorry. If they went below 80, that's probably where I'd pick them up, but I think they're a little bit overvalued where they're at right now. So anyway, that's what I wanted to bring up today. If you liked the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.